Listen very closely. Right now, we are standing on a pocket of air that looks like strength but smells like a distribution trap. The S&P is hovering at 7,398, pushing all-time highs, and Bank of America just dropped a quiet warning that the mechanical CTA buying, the vol control bid that has been mindlessly pumping this market for weeks, is gassing out completely. If you are blindly chasing these highs right now, you are the exit liquidity those algorithms are hunting. There is exactly one danger zone and one hidden opportunity left in this melt-up. I'll show you both with absolute clarity. Stay until the end, because I'm giving out 3 specific entry and exit levels you can use immediately, including the exact invalidation number that proves the bears wrong and turns everything into a face-melting squeeze. This is your instant market verdict. Put your eyes on the chart. The session bias today is a fading breakout. I'm officially classifying this as a bull trap in formation, not a trend continuation to buy. The daily and 4H trends are technically still bullish. I'm not denying that, but the internal momentum is fractured, and the location is terrible for new longs. I will be selling into climactic pumps at resistance, or buying a very specific low contrast dip into the liquidity pocket below. The single number you must tattoo on your mind is 7,438. That is the level that changes everything. Write it down. Now, a 4H candle body close above 7438 would completely invalidate the BOF-A CTA exhaustion signal, crush the trap shorts, and open the floodgates for an aggressive liquidity grab into the 7,500 zone. Until that happens, I will treat every tick higher with suspicion. The structure is a slow grind wedge, not a vertical impulse, and that is the most dangerous place to be a late buyer. Now, let's walk the chart from the top down, because this is where most traders miss the fractal setup. Start on the weekly time frame. Price is riding steeply above the 20-week moving average, which sits all the way down near the 7,100 handle. That 20 is sloping up. The 60-week and 200-week MARs are stacked in a perfect bullish staircase below it. From a pure textbook definition, the long-term trend is bulletproof. But look deeper. The weekly MACD is printing positive histogram bars, yet those bars have been shrinking against the rising price for 3 consecutive candles. That is a classic momentum divergence. It's not an immediate crash signal, but it tells you the trend is aged, gassed, vulnerable to a sharp vertical mean reversion. The market breadth reading on the advanced decline line isn't confirming these highs either. We are seeing fewer stocks participating. This is the liquidity tide pulling back beneath the surface. When the generals keep marching higher but the troops behind them are falling, the battle is about to turn. Rolling into the daily time frame, the picture becomes even more fragile. The 20-day moving average has been the dynamic support that guided this rally, currently sloping up right at 7,284. That's no coincidence. It matches our second key support on the sheet. The 60-day is down near 7,150, and the 200-day is way down at 6,900, meaning we've stretched so far from the long mean that the rubber band is wound tight. The daily MACD is completely flat. There is no acceleration, no expansion of buying pressure. It's a low volume, grinding drift into the resistance box between 7,411 and 7,438. That kind of low volume breakout is the textbook setup for a failed breakout, what I call the whale trap. It happens when the last momentum chasers pile in, and the smart money delivers shares into their stops. The volume profile confirms it. The most traded price in the last 2 weeks sits right at 73.90, exactly where we are now. That means any sudden move away from this level will leave behind a huge pocket of trap traders. Now descend to the 4H execution chart. Here, a rising wedge has formed, with the upper boundary sitting at the 7,411 region and the lower boundary near 7,360. The 20-period moving average on the 4H is at 73.85, and we are stretched above it. The 60-period is at 73.30. But the critical visual is the 4H MACD. We have a small, insidious negative divergence. Price is making marginally higher highs, but the momentum oscillator is making a lower high. In plain terms, buyers are completely exhausted, walking up an escalator with the power off. The moment gravity kicks in, the snapback will be fast and unforgiving. I want you to visually place these numbers on your chart. The ceiling is 7411, the floor is 7310, and the air pocket below the floor is 7284. Within this range, the S&P is just rotational noise designed to shake out weak hands. Money is made only when you touch the edges with precision. Here's what most traders miss right now. And this is the core of the cross-asset linkage. The S&P 500 is not trading in a vacuum. It's moving tick for tick with the crypto risk spectrum. And that correlation is breaking down in a very instructive way. Bitcoin has completely stalled its upward march exactly as the S&P has pressed these new highs. The Nasdaq futures balance volume is not confirming. The dollar index, which should be tanking if this were a genuine risk-on melt-up, is holding stubbornly above a key support, acting like a silent antagonist. When the dollar doesn't roll over and Bitcoin doesn't confirm, the equity rally is being driven by a very narrow, mechanical flow, not by organic conviction. This is the liquidity tide receding. I'm seeing rotation within the equity market, not inflow. Money is moving out of growth and into defensive names even. As the index ticks higher. That's a classic topping narrative that sucks in breakout traders before the rug pull. Let's connect the fundamental driver directly to the price action over the last 24 hours. The core news isn't just that the S&P is at new highs. The core news is that Bank of America's quantitative analysts, who track systematic CTA and vol control fund positioning, are explicitly warning that this buying flow is losing momentum and will soon reverse. For those who don't live in the institutional flow world, CTA funds are trend-following algorithms that buy when volatility is low and the trend is up. They are leveraged and mechanical. When they hit maximum long, there is simply no one left to buy. The options dealers are simultaneously short massive amounts of call gamma at the 7400 strike. That means they must sell more futures to hedge as we tick higher, creating a temporary ceiling. But the moment we lose that ceiling, the Vanna and charm effects amplify the drop as they unload their hedges. This evening's lack of a fresh dovish catalyst from the Fed speakers leaves the door wide open for this flow reversal. My 1 to 2 week directional lean is for a jagged correction back to the weekly equilibrium, somewhere in the 7100 area, retesting that weekly 20 MA. That's not a crash call. It's a normalization trade. The exact price event that would invalidate this thesis is a daily close above 7438 with expanding volume, which would signal that the organic bid has returned and the CTAs have been reloaded. Until then, we trade the exhaustion. Most people will click away right now, but this next section is exactly where money is made in this market. Put your distractions aside and watch carefully because I'm giving you 3 complete setups with exact triggers, precise stops, and asymmetric reward targets. Strategy 1, the sniper. This is the conservative, high-probability reversal setup designed for patient traders who want to sell into strength without guessing. The trigger is a spike into the 7411 resistance zone. You do not market sell the level. You wait for a rejection candle on the 15-minute time frame. That candle must be a long-wick shooting star or a full bearish engulfing pattern that closes back below 7395. The entry is on the break of that local candle structure, so a sell stop order around 7390. The stop loss goes above the high of the trap candle, maximum at 7420. That gives you a tight 30-point risk. Your first target is the 38.2 retracement of this leg, at 7365. Your second target is the 4H support floor at 7310. If target 1 is hit, move your stop to break even immediately. The risk-reward ratio on this setup is 2 to 1 on the conservative capture, and greater than 3 to 1 if the full flush occurs. The sniper setup is completely voided if the S&P prints a 15-minute close above 7438. If that happens, take a small loss instantly and flip to the long side. Strategy 2, the active trader. This is for those who understand that the dominant trend is still up on the daily, and they want to join it on a deep, high-contrast dip instead of chasing tops. You wait for a rapid flush into the support cluster between 7,310 and 7,284. This must be a 1-hour candle that penetrates below 7310 to sweep the early long stops, then immediately produces a strong bounce. Do not buy the first touch blindly. Wait for a bullish engulfing candle on the 15-minute chart, accompanied by an MACD cross to the upside from an oversold condition. Entry is around 7,300. The hard stop goes just below the daily 20 MA and below the low of the sweep candle, so place it at 7,275. That's 25 points of risk. Your first target is the mean reversion back to the breakdown point at 73.80. Once target 1 is hit, move your stop to break even and let the second target run to the macro high at 7,398. At that point, apply a trailing stop of 20 points on a 15-minute close to lock in profit. This is the buy the dip mechanic that works in aging uptrends. You are capturing the trap short covering that always occurs after a fast stop run. Pause here. I want to build out an interaction mine right now. Let's see how align this. Community is with real price analysis. Type your S&P 500 range for tomorrow's session in the comments below. Are we breaking above 7,400 and turning it into support, or are we flushing down to 7,300 to fill the imbalance? I read these comments every evening after the close, and I'll shout out the traders who called the range correctly. Now for strategy 3, the aggressor. This is strictly for high-risk traders who understand how to lose small and manage size aggressively. It's a counter-trend false breakout chase. We are looking for a textbook liquidity grab above the 7,411 resistance. The setup requires price to print a 5-minute candle that pokes above 7,411, perhaps even 7,420, and immediately reverses. The very next 5-minute candle must close back below 7,400. That sequential pattern means the breakout was a fake, trapping the breakout chasers. Your entry is at 7,398 on the speed of the rejection. The stop loss is brutally tight above that grab candle's high, placed at 7,415. You are risking only 17 points. The target is the panic flush into the dense liquidity pool sitting at 7,310. That's an 88-point profit potential, giving you an asymmetric reward to risk north of 5-1. But understand, this setup requires lightning execution and the emotional discipline to accept that you will be stopped out instantly if the real trend reasserts. Only trade this if you have already mentally written off the risk. As we exit the trading setups, hear this non-negotiable risk management pulse. Never risk more than 1 to 2% of your account on any single trade. We have high-impact economic data drifting through the week. No open positions should be held blindly through those events. Stops are not suggestions. They are the only line of defense between a controlled loss and a blown account. As we close this session, the single most critical level you must stare at tonight and tomorrow morning is 7,310. That is the bull-bear line for the active session. Lose that, and the trapdoor opens to a fast test of 7,200 and likely a reconnect iron with the day 20 moving average. Hold it, and the melt-up engine still has a weak pulse, giving us one final grind back to the top of the wedge. Tomorrow, I'm releasing a deep dive video on the exact divergence between the S&P 500 and Bitcoin. That divergence is currently screaming a risk asset correlation collapse, and it has massive implications for both crypto and equity holdings. That video is linked on the end screen right now. If this breakdown gave you a crystal clear plan for today's S&P game, smash the like button, subscribe and ring the bell for daily institutional coverage before the market moves. I'll see you in the next one.